Today we are going to discuss about production function with two variable factors, which is known as isopoints. So what is isopoint? It is also known as production function with two variable inputs or equal product curves. Then according to Peterson, an isopoint curve may be defined as a curve showing the possible combination of two variable factors that can be used to produce the same total outputs. Then an isoquant represents all those combination of inputs which are capable of producing the same level of output. And isoquants are also called equal product or isoproduct curves. Since an equal product curve represents all those combination of inputs which yield an equal quantity of outputs. The producer is indifferent between them. Therefore, another name for isoquant is production indifference curve. Then assumption of isoquants. What are the assumptions for isoquants? First point is two factors of production. In isoquants, if we are talking about isoquants, there must be two factors of production. The only two factors are used to produce a commodity, and in generally assume that there are only two factors or inputs of production. This makes the geometric exhibition of the concept easy since we can easily draw a diagram. If we abandon this assumption and consider 4 or 5 factors of production, in keeping with the reality, we would not be able to make use of the diagrammatic representation and would have to resort the algebraic method. So we have to use only two factors of production. Then divisible factors. So factors of production can be divided into small parts, small unit, and can be used in various proportions. The next is constant technique. Technique of production is constant or is known beforehand. Technical conditions of production are given and it is not possible to change them at any point of time. Then possibilities of technical substitution. The substitution between two factors is technically possible, that is production function of variable proportion type rather than fixed proportion. Then efficient combination. Under the given technique, factor of production can be used with maximum efficiency. So these are the assumption of isopoints. Then types of isopoints. What are the types of isopoints? First is linear isopoints. What is linear isopoints? Here there is perfect substitutability of inputs. For example, a given output says 100 units can be produced by using only capital or only labor, or by a number of combination of labor and capital, say 1 unit of labor and 5 unit of capital, or 2 unit of labor and 3 unit of capital, and so on. Likewise, given a power plant equipment to burn either oil or gas, linear isoponds. Various amounts of electric power can be produced by burning of gas, only oil, or near varying amounts of each. Gas and oil are the perfect substitute here. And here the isoponds are straight line, then rectangle isoponds. Here there is a complete non-substitutability between inputs, or we can say it strict complementary. For example, exactly two wheels and one frame are required to produce a bicycle, and in no way can wheels are substitute for frame or vice versa. Likewise, obviously, खाली frame को रखिबा wheel को न रखिबा तो cycle केमती चलिबो. Likewise, two wheels and one chassis are required for a scooter, and this is also known as input output isopon. Then convex isopon. This form assumes substitutability of inputs, but it is not perfect. For example, a shirt can be made with a relatively small amount of labor, large amount of cloth. The same shirt can be well made with less cloth if more labor is used, because the tailor will have to cut the cloth more carefully. And if the tailor is more careful about when he cutting the cloth, then it reduce the wastage. And finally, the shirt can be made with still less cloth, but the tailor must take extreme pains so that labor inputs requirement increases. And this is all about types of isoponds. Then properties of isoponds. First point is isoponds are negatively sloped. Normally, isoponds slope downwards from the left to right, implying that they are negatively sloped. The reason for that characteristics of the isopond is that when the quantity of one factor is reduced, the same level of output can be achieved only when the quantity of other is increased. Then our next point is higher isoponds represent a larger output. A higher isopont is one that is further from the point of origin. It represents a larger output that is obtained by using either the same amount of one factor and the other greater amount of him other factor, or other greater amount of both the factor. Then it is called higher isopont, represent a larger output. Then no two isoponds, number of two isoponds intersect or touch each other. Okay, isoponds do not intersect or touch each other because they represent different level of output. Then isoponds are convex to the origin. In most production process, factors of production have substitute. Often labor can be substituted for capital and vice versa. However, the rate at which one factor of production is substituted for other is production process, that is marginal rate or technical substitution, जोटाको आमे short रे कहूचे कोन ना MRTS, and often tends to fall. It's all about our two variable production function with two variable factors. Then our next is cost analysis. The cost analysis refers to the measures of cost output relationship, that is, the economists are concerned with determining the cost incurred in hiring the inputs and how well this can be rearranged to increase the productivity, which we are saying output of the firm. In other words, the cost analysis is concerned with determining money value of inputs, for example, labor, raw material, called as the overall cost of production, which helps in deciding the optimum level of production. And cost analysis also refers to the study of behavior of cost in relation to one or other production criteria, namely size of output, scale of operation, price of factors of production, and other relevant economic variable. Cost analysis deals with the behavior of cost given certain production relation. In other words, cost analysis is concerned with financial aspect of production relation and against physical aspects considered in production analysis. Then, before going to cost analysis, let's discuss what is cost. Cost is defined as those expenses faced by a business in the process of supplying goods or services to consumers. In economics, the cost of production is the value that the price of an object or conditions is determined by the sum of the cost of the resources that went into making it. The cost can compose any of the factors of production, including labor, capital, land, entrepreneur, and taxes. Then our next point is types of cost. First is opportunity cost and actual cost. Opportunity cost is the loss of earning due to lost opportunity. Opportunities are foregone due to scarcity of resources. And if resources were unlimited, there would be no opportunity. And the opportunity cost may be defined as the loss of expected return from the second use of the resources foregone for availing the gain from their best possible use, since opportunity cost is the income expected from the second best alternative use of resources. Then it is also called alternative cost. Then business cost and full cost. Business cost include the expenses which are incurred in carrying out next is business cost and full cost. Business cost include all the expenses which are incurred in carrying out a business. The concept of business cost is similar to the actual or real cost. Business cost include all the payments and contractual obligations made by the firm together with the book cost of depreciation and plant and machinery and equipment, etc. And the concept of full cost includes business cost, opportunity cost, and normal profit. The opportunity cost includes the expected earning from the next best of the resources or market rate or interest on total money capital, and also the value of entrepreneur own services which are not charged in the current business. Normal profit is necessary minimum earning in addition to the opportunity cost which a firm must get to remain in its present occupation. Then our next point is direct cost and indirect cost. Direct costs, which are those costs that have direct relationship with unit of operation. That is, they can be easily and directly identified or attributed to a particular product, operation, or plant. For example, the salary of a branch manager is a direct cost when the branch is a costing unit, and direct costs directly enter into the cost of production but remain their separate identity. Then indirect costs are those costs whose source cannot be easily and definitely traced to a plant or a product, a process, or a department, such as electricity, stationery, and other office expenses, depreciation on building, decoration expenses. These are called indirect costs. Then incremental cost and sum cost. Incremental costs denote the total addition of cost associated with a marginal batch of output, and these costs are the addition of costs resulting from a change in the nature and level of business activity. For example, change in production line or output level, adding or replacing a machine, change in distribution channel, etc. And some costs are the costs that are not affected or altered by a change in the level or nature of business activity, and it cannot be altered, increased or decreased by varying the level of activity or the rate of output. All past or actual costs are related to a sum cost. Then historical cost and replacement. The historical cost cost of the cost actual cost of an asset incurred at the time of the asset was acquired. It means the cost of a plant at a price originally paid for it. In contrast, replacement cost means the price that would have to be paid currently for acquiring the same plant. So historical cost are the past cost and replacement cost are the present cost. And price changes over time because difference between historical cost and replacement cost. For example, if a machine price is 1 lakh in 2001 and its present price is 2 lakh, the actual cost is 1 lakh, which is historical cost, while 2 lakh is the replacement cost. The past cost and future cost. Past cost are the costs which have been actually incurred in the past. They are beyond to the control of the management because they are already incurred, and these costs can be evaluated with retrospective effects. On the contrary, future cost refers to the costs that are reasonably expected to be incurred in some future period. They involve forecasting for the control of expenses, appraisal of capital expenditure decision on new projects, as well as the expansion programs and profit loss projection through proper costing under assumed cost conditions.